Love it. All these questions at GarrettGunderson.com/WWGD. What would Garrett do? Used to be people thought I looked like Jesus. I got really gray though.
Yeah.
You know?
if
My wife
Jesus
was like,
was
"You're
able to
really
get old
gray."
enough.
He had a more stressful life.
I know. A little bit.
Yeah. All right. So this question here from Dan says, if a person can fund a whole life policy, IBS, Infinite Banking Solution System, with up to 90% available to loan back to themselves in the first year, what keeps people from taking a loan from one policy to fund the premium of another? Wouldn't you be making interest twice on the same dollar, assuming that you don't just pay the loan back from the first policy?
Well, so, all right, let's talk about that. So this is one of the challenges I have with infinite banking as a whole, is this idea of positive arbitrage being the purpose and the intent and the only use or the only reason that people want to get a policy.
Right.
Right.
It neglects any value in the death benefit.
Right. And it's also misleading, like wildly misleading. Like the idea, I think it's really important to understand.
I like that people at least are asking questions and advancing these thoughts, but like we need to 100%. Get to the reality of how 100%. Would this work and what risk would you face?
Well, so let's talk about that for a sec, because there's always mortality charges and cost of insurance and admin fees, and all those fees are the highest in the early years of the policy, right? If the policy stays in force long enough and you do your job and you pay your premiums and you live long enough, obviously, the policy is going to become very efficient. I think once you hit year 10 in a policy, especially an overfunded policy, it's probably not going to be a more efficient asset in your life, right? But you got to be willing to do the first 6, 7, 8 years first, right?
Right.
So if, like, when we talk about like human behavior and user behavior and whatnot around policies, okay, if you've got policies that are 10 years old, right? So like if you go to borrow against your policy at year 10 or 12 or 15, you can behave a little bit differently with that money because it's a bit more mature. The dividends are more efficient. The costs are lower.
It's like an airplane taking off is going to use a lot more gas once it's at cruising altitude.
100%. And so you can get away with it at that point in time. The problem is if you, and from that perspective, there are instances and circumstances where you could borrow against it and never have to pay it back and you're okay. And I've done videos that show, like, what does it look like if you borrow?
But it has to, like, certain things have to happen.
Totally.
Life doesn't quite work that simple.
100%. But what we know for certain is that if you borrow from year one in your policy and you never manage that loan, you're probably going to have problems.
All right, let's take a look at an actual policy here.
So let's look at a policy here. So here's what we have. We have a 1090 policy, 10% base, 90% paid up additions, and so that's overfunded 90%. And you can see out of this $10,137 premium, you have $8,911. So a couple things to know. Like, this is basically 90%. Remember, in order to do this, we had to do it. There always has to be a term rider.
Right, because otherwise you mech it, which means that you lose some of the tax benefits.
Right. So out of this, it's not just 10% base, 90% paid up additions. It's 10% base,
term insurance,
then term insurance costs, and then the balance goes into,
because that's a pretty high death benefit, $220,000.
Yeah.
Off of whatever the base premium is.
Totally.
Right. The base premium being what, like $1,285.
Yeah.
But that's because of the term rider.
Correct.
Yep.
And so what we look at here, though, is like, all right, after the insurance costs, after the term rider fees, after everything with the paid up additions that go into it, you're looking at $8,911 of the net cash value year one. Okay. Out of this money, you have 90%. Let's just call it 90% that you could access through a policy loan. Okay. So let's just call it $8,000.
Okay.
Keep numbers round. So you could borrow against this at $8,000. So what the person, is it Dan, was asking is saying, hey, why wouldn't I just borrow against that $8,000 and use that $8,000 to buy another policy for $8,000? It's because the idea here is, all right, let's use a really simple example that I think a lot of influencers and agents are creating content around and misleading people, and this creates confusion because it's where questions like this come from. So I get it, and I love that he's asking this question because I rail against this all the time because I think it's one of the most misrepresented elements of whole life insurance as much as I like to bang on IUL.
We're talking about risk management, yet this is creating risk.
Totally. Yeah. And so here's the deal.
How much different is it than being like, if I could put 10% down on a property and then I buy it with 90% loan, and then now, even though I had 40% down, I can do that with 3 more properties, but now you've got 4 properties, and if the market doesn't cooperate or something happens, or what if it was a variable interest rate on the loan, or there's a number of things where people got over leveraged in real estate and they get hurt.
Right. And so as long as you manage whole life properly and your expectations and your behavior with it are in alignment with reality, it's really safe leverage. If you get out of alignment with that, then and you don't understand the moving parts, you can get yourself into trouble.
The world has kind of gone this route where it's like, okay, well, here's a tool. How can we make that much better? But then you lose the very reason of having the tool.
I know.
It's like, hey, here's something that's risk mitigated capital.
Yeah.
Alternative to maybe bonds, and it prevents that capital appreciation when interest rates raise, or maybe does better than a savings account most of the time with a bunch of benefits.
Yeah.
If it's good, more must be better. Let's just go and now strip a lot of that, risk managed capital to take more risk, because now it's in the form of a loan, getting another policy.
Yep. It's crazy.
Yeah.
And the sensationalization that these influencers that talk about that, it's mind numbing to me. But what we're looking at here is like, if you let's just say you take this $8,000 loan and you buy another policy. You have the law of diminishing returns, because like, let's say, because if the principle is like you could do it with the first one, why not do it with the second one? Why not do it with the third one? At the end of the day, you're going to hit your the amount of insurance that the insurance company is going to be willing to give you. So there's that. But secondly, from a dollars and cents perspective, it doesn't make any sense, because here's the deal. Like, the way it's sold and the way that Dan probably thought like it would make sense is that, all right, let's say I could borrow in this instance against this company, 5.7 is the loan rate. Let's say I could have a 6% dividend, right? If that were the case, and I'm not saying it is, but I'm just using a kind of a scenario here. If I could borrow at 5.7 and earn 6, this Dan's going, well, that's arbitrage. Why couldn't I do that?
But there's fees.
Right? So whenever you look, and this is something that most people don't talk about, like, as much as you and I love whole life, the dividend is wildly misrepresented on how it credits to people.
It's the gross dividend before expense.
Right. So every company, I don't care what company, there's one company that is an exception to this, and I'll talk about it in a second. Every company declares a dividend, and let's say it's 6%. That's the gross dividend. They're going to back out mortality charges, fees, operating costs of the company. Because remember, as the policyholder, you are participating in the profitability of the company. They're saying a 6% dividend, then they're going to back out their expenses to get to profitability, and that's what you share, and that's the dividend. And so, like, to me, the dividend is kind of misleading, quite frankly. And there's no guarantee. You could have a company that says that documents 5.65 or 5.5 for a dividend, and another company that documents 6, and they may end up paying the same dividend. You know what I mean?
Because it's revenue versus profit.
100%. And so from that perspective, that's why I always say I hate selling off of illustrations. And I can't stand when we run into a situation where, they're like, oh, this company looks way better on paper than this company. It's like, it doesn't really matter. Like, the illustration, it's outside of year one is kind of smoke and mirrors, right? Like,
someone might have a great resume, but not be a better employee than someone that's just better at their job, but doesn't know how to write it down on paper as well.
For sure. And so there's one company, and we do work with this company, but and I'm not saying they're the best, and I'm not saying but I do like this element of them. It's One America. They refuse to declare their dividend. They refuse to be public about it. And so some people look at that as like, shifty. Like, they look at it as like, well, why wouldn't they declare a dividend? And their stance is like, we're just not playing that game. Like, because it's all kind of misleading anyway. So we're going to just give you a higher guarantee, which is what they do. And that's kind of what they sell on, is their guarantees are better. And we're going to pay a dividend too, but like, we're not going to sit here and mislead you as to a higher dividend and then reduce it on you.
Policy, so.
Yeah. So like, you know what I mean? And so they're a smaller company. They're a great company, in my opinion. They have different things they do well, and there's certain situations they're great. But like, I do think that's a unique, I like, just principally speaking, that culturally they're just like, you know what? Like,
so the first issue here is net versus gross.
Yeah.
The second issue is the interest rate that you're actually paying to borrow the money, and now starting a new policy that's in its least efficient year.
For sure. And that part, that first least efficient year. So like when we look at this, look at this illustration here, right? So you got $10,137 going in, $8,911. Next year, $10,137. It grows by $9,719. So you could see there's extra costs and everything that are going in there now.
Which, by the way, we're in third year, 10,137, 10,178. I just want to point this out to other commenters on YouTube. Like, they're like, where you're getting it, where it's at break even, and the third year. Yeah. Well, that's the amount coming in.
It's pretty solid.
Yeah.
That's pretty solid. And so, I just look at this as like, you're not going to be able to just borrow against the policy, pay another premium, and do that.
If you were, there's a better alternative. You could do a much bigger policy right up front, right? Where you could get a lot of death benefit, so you're not applying for it over and over with one policy and having premium financed with this, where a bank actually finances the premium rather than you financing the premium, and then you're at least getting all your death benefit at once and a much bigger policy.
Yeah, I mean, that's an option if you're a high net worth person and you have that and you want to leverage bank money. I'm not a fan of premium finance.
Right now, it's a little bit tougher because interest rates are so high, and a lot of people are taking advantage of that during low interest rate times.
I know. That's a whole nother conversation. I've never been a fan of premium finance, even in the low interest rate environment, because I knew that this was going to happen. Right. And so those people that got it in low, now they're having to pay high interest rates. And so if they didn't plan for that, and if they're not really high net worth and can't just come out of pocket to make up the difference, they're exposed to risk. And to me, the whole purpose of doing something like this,
I'm just saying it's a better step than this.
100%.
Not
100%.
saying that it's the solution.
Yeah. I mean,
because here's the thing, you're going through parameds each time.
Totally.
That's a lot of time.
Yeah.
You're paying, the least efficient time in the policy. Mm-hmm. You've now got multiple loans that you're managing and multiple policies that you're managing from those multiple loans.
Yeah. We
don't know what the dividends are going to be in the future.
Right.
We don't know what interest rates are going to be in the future. It's like you're just putting yourself at risk.
At the end of the day, if you were able to get positive arbitrage, it would make sense. But that's not what it's about. And you certainly don't get positive arbitrage in any policy in the first couple of years. If you wanted to wait 10, 12 years and we're in an environment where interest rates lower and dividends are still higher, you may be able to pull it off, but it will certainly be circumstantial.
Regular attention and maintenance.
Exactly. So just know that.
Cool. There you go, Dan.